Greetings, members one and all of the Salivation Nation. The stock market took a pretty big tumble today. So why did gold and silver go down? Let's explore. That is the question. Sometimes this happens. But it turns out the reason is fairly simple. It looks like that is due to the dollar and the yen gain on bleak Fed view and Wall Street sell-off. So when the dollar goes up, typically gold goes down, and silver too. That's what this article is about here from Kitco News, coming to us from Reuters. The safe haven dollar, yen, and Swiss franc gained on Thursday as U.S. stocks tumbled amid diminished expectations that the global economy would recover swiftly from the coronavirus pandemic. The yen rose to a one-month high against the dollar, while the Swiss franc climbed to a fresh three-month peak. The dollar index, though, gained for the day as investors sold currencies associated with risk-taking, such as the euro, sterling, and the Australian dollar. Today, the animal spirits aren't so strong, says Mark Chandler, who is the chief market strategist at Bannockburn Global Forex in New York. One trade is rippling through the markets, taking profits on equities, beating up on emerging markets, unwinding gains in these leading currencies, and flocking to the safety of the debt markets. Currency traders took the cue from the U.S. stock market, where the S&P 500 was on track for its worst days since March. The historic gain in equities is getting a reality check. There are some concerns about reinfections, but the thought today is that not so much different from the beginning of the week, said John Doyle, Vice President of Trading and Dealing at Tempest Inc. in Washington. But perhaps because of how fast and how hard equities have gone up and the dollar has gone down, traders are looking for an excuse to take profits and take them off their highs and the dollar off their lows, he said. Since late May, with better than expected economic data and economies and the U.S. states starting to reopen, the dollar has fallen 3.5% against the currency basket. Demand for safe haven currencies increased after the Federal Reserve issued a dire outlook on Wednesday. Following its two-day meeting, the Fed signaled its plans, years of extraordinary support for the U.S. economy, which policymakers project will shrink by 6.5% in 2020, with an unemployment rate at 9.3%. Investors were also worried about new coronavirus infections as the world gradually reopened following shutdowns aimed at curbing the spread of the disease. In the United States, new infections are rising slightly after weeks of declines. According to a Reuters analysis, part of the increase is due to more testing, which hit a record high on June 5th of 545,690 tests in a single day, but has since fallen. So there you go. I think that is one of the concerns, and that is actually causing some analysts to predict that gold will go up to $1,800 this year because of it. Gold prices could be expected to surpass $1,800 an ounce, marked by third or fourth quarter this year, with near-term signals remaining bullish. This is according to Gary Wagner, which is editor of the goldforecast.com. Wagner's comments come as the Federal Reserve announced Wednesday to keep rates near zero until at least 2022. And stocks fall on fears of a second wave of the coronavirus. It is unlikely that economic growth will surprise to the upside anytime soon, forcing the Fed to change their dovish stance, Wagner said. And I think we can pretty much bet on that, considering how long they want to keep those interest rates down. You have to go back to their primary mandate, which is low inflation and high employment. So when you have to, we have so many people unemployed, to reach maximum employment, which is the term that they use, in order to get there, we would have to see a lot of people go back to work. Do I foresee a situation where that could happen? Yes. Do I see that happening with a high likelihood of occurrence? I would have to say we would really have to see some changes that we're not seeing now, he said. Structural problems in the economy, including high unemployment worldwide and high levels of debt accumulated, still remain, he added. He noted that while the economic recovery is in the opening innings, we have yet to see the full repercussions of quantitative easing. That's right. And they're betting on that we won't see that for quite some time. Regardless of when they turn that switch, we may not even begun to encompass or feel the economic fallout that will come from the moves made by the Treasury Department and the Federal Reserve. Meanwhile, a second wave of the virus has just been reported to begin sweeping across the U.S. as the overall count of infections just passed 2 million. If there wasn't a second wave, I would be very surprised. I think that almost has to be because of large masses of people that came together without masks and without social distancing, Wagner said, referencing the recent mass demonstrations taking place around the world in response to the death of George Floyd. Gold prices are showing upwards momentum, and this should continue until the end of the year, Wagner said. We have been caught for about 3 months in between 1680 and 1750 per ounce. It's going to have to break below or above those range levels before we see the next move. The feeling is the break will be to the upside and not to the downside. But in this environment, anything can happen, that's for sure, because another analyst, Anna Golubova, says that it will shed $150 by the end of the year for fear of runaway prices is premature. Another article dated today, the gold prices are likely to end the year at $1,600 an ounce, which is $150 below the current level of $1,750. It's actually $1,726 now. The main reason for such a bearish outlook is the argument that fears of runaway inflation are premature in the short and medium term, said Capital Economics Commodities economist James O'Rourke. What this means for gold is weaker safe haven demand and lower prices by year end. Despite fears of runaway prices, we think the stimulus-fueled inflation is unlikely in the short or medium term. With interest rates set to remain historically low, we expect the gold price will come under pressure from fading safe haven demand, falling from $1,600 per ounce by year end. And at the time of the writing, the COMEX gold futures were trading at $1,751. Gold prices have been rallying after a major sell-off in mid-March along the stocks. The stellar gold price performance has been led by COVID-19 uncertainty, lower interest rates, and expectations of runaway inflation triggered by the massive stimulus injected into the global economy. The year's rally in gold prices come on the back of a coronavirus-led surge in safe haven buying and a plunge in interest rate expectations. More recently, however, we suspect that the uptick in the gold price has come from investors positioning themselves against the risk of inflation, that we don't expect it to pick up much in the short term. Expectations of higher prices have been driving gold most recently, which explains why gold has been rising alongside with stocks in May and the beginning of June. But today it was the opposite. They were kind of going down. And I think a lot of this is, with the equity market selling off and everything, and concerns about the economy in general. Let's take a look at those markets again. They're down. It's crazy. The Dow is down 1,861 points now. NASDAQ down 527 points. S&P down 188. So those are pretty big dips, 6%, 5%, almost 6%, almost 7% for the Dow Jones. But, and even though given where gold is up, look at the percentage moves for gold and silver. Not nearly that much of a dip. They did hurt. They did suffer a bit because of that dollar, but not by much, which tells us something that even amidst the rising dollar, gold and silver really are holding their own. However, silver did take a bigger hit on the day than gold did. Still, it does go to show you that really the ultimate safe haven, even though most people in the marketplace were reacting to the safe haven of stable currency such as the dollar, the ultimate safe havens are gold and silver. Platinum took a hit today too, the biggest hit in fact, with a $32 drop, almost a 4% decline, and palladium took a $26 hit today, over 1.3%, under $2,000 now, 1971. So there you have it. An interesting news day. You don't see this too often, but it does happen. But considering how far the markets have fallen today, usually gold and silver will go up. But because of what I explained earlier, and they're not doing that. So there you have it. And they're down, but they're not down by a whole lot. My guess is if we see tomorrow the same type of activity in the markets, then we'll see gold and silver bounce back. Fascinating indeed. Let me know what you think in the comment section below. I'd like to extend a multitude of gratitude to you all for taking the time to watch and encourage you to please rate, share, comment, and subscribe.